Hello, I'm Charlotte Taylor-St.Ruth. I'm Director of Francis Clark Financial Planning and Head of our Client Experience. I'm joined today by Mashud Rahman, our Head of Investments. Welcome, Mash.
Thank you.
Current hot topics still, interest rates and inflation. Have you got any good news for us?
Yeah, well, I suppose today we're in a much better position than we were 12 months ago. I think gone are the days where we have to be worried about double-digit inflation or constant interest rate hikes. I don't think we need to worry about that anymore. But I would say that we can't take our foot off the gas just yet. So whilst we've seen interest rates come down, earlier this year we did see a little bit of noise from the Federal Reserve in the US saying that they might have to hike rates just to make sure inflation does come right down. That doesn't seem to be the case anymore, and central banks in general are hinting towards rate cuts. But we do need to wait for inflation to come right down to those target levels of sort of 2–2.5%. So we're waiting for that to happen, and hopefully we will see that happen and take place over the next sort of 6 to 12 months.
Okay, good. So some good news there, heading in the right direction, but not quite where we want it to be just yet. So how about markets, global markets, what's going on there?
Generally, markets have performed really well this year. I think that equity markets in particular are quite happy with central bank policy, and they are glad to see inflation coming down and interest rates sort of starting to make their way down. This quarter we saw some really good returns from the US, UK and Asia. Europe struggled a little bit, just edging into the negative territory, but this quarter, similar to last quarter, I'd say the region in focus is Japan. A few months ago I was writing our blogs saying how Japan was really the standout region last quarter with such phenomenally high returns. It's the opposite way around this time. Japan struggled this quarter. Not to say that it's struggling for the year, it's still up sort of 10% year to date, but I think this quarter just went through some volatility to perhaps put it into some correction, bringing it slightly closer towards normality. Fixed income markets are sort of behaving as I would expect them to, fairly flat, and I suppose the outlook in that region is basically the same for the year as well.
Okay, thank you. That's a good update. So what would you think are the key takeaways then that we can take forward into the second half of this year?
So yeah, as I said, 2024 has been a really good year for markets. Now I don't think that momentum is going to carry on sort of into the second half of the year. I think perhaps we'll see a little bit of a slowdown in that pace. I don't think we're going to see about volatility unless inflation rises again. But I do think we are going to be going through more sort of challenging environments in the investment landscape. So I suppose if you look at examples like Nvidia, a stock which has had some really strong growth figures, but at the same time going through sort of 10 to 15% drops in a single day, we want to avoid companies like that. So I think that is just highlighting how different the current market environment is, and as a result I think having some really good sound active management in place in your portfolios is going to play a much more crucial role this year than it has sort of in previous years.
Okay, thank you, Mash. So with that in mind then, I think our listeners will be wondering how that affects their portfolios and what we'll be doing with that.
Yeah, so I'd say in our portfolios the focus at the moment is diversification. It's absolute diversification. It's not just diversifying across regions but also asset class and styles as well. So by styles I mean you've got value, which is, I suppose, it's a bit like the label, is where an investment is presenting good value, where the price of the investment doesn't necessarily reflect what it's worth. So take a company that's oversold but still has good earning potential. We've also got momentum style investments in there, so I suppose that's companies which have got good momentum going at the moment, so the market is in favour of that type of investment, so it's making sure that we have those in the portfolios too. And then quality, and I suppose that is just those companies which are a bit of an all-rounder, just really strong businesses, good growth plans in place and strong earnings as well. We are focusing on diversification. We are also sort of looking at regions a little bit more carefully. So at the moment, China, we're currently patiently underweight in that space. So it's a really interesting region, but not quite ready to dive into there just yet. So we're waiting to see what unravels over there. Hopefully we can sort of get a little bit more involved over the next couple of years. In our portfolios in specific, we are looking at an overweight in consumer discretionary. We are overweight slightly in healthcare, energy, and just looking more towards consumer staples as well. So just looking at parts of the market which our investment management partners think that presents a much better opportunity, not just for growth, but to be sort of a good risk-adjusted position in the portfolios too.
Excellent. Okay, thank you. And one thing I'm hearing quite a lot at the moment from clients is, how's the election going to affect my investments? So we've just had the general election in the UK, a new government, and the election coming up in the US. It's on the minds of a lot of clients at the moment. Does this affect markets? Is this going to affect their portfolios?
Yeah, good question. So historically speaking, changes of government and changes of leadership have had really minimal impact on markets. So if you were to draw a big chart going back to the early 1900s, and you'll see the different governments in place, it doesn't change the trajectory of markets when a government changes from one to the other. And it's very much the same today. Whilst we are in a Labour government now, if we go back a few months ago, markets priced in Labour, but if we were to see Conservative win, the general forecast I would have had a minimal impact on markets, and that comes down to, at the end of the day, their economic policies are not very different to one another. So the actual impact it would have on markets is minimal. So not a huge change in markets, nothing really changes in expectations. In the US, we've obviously got the election coming up over there as well. Slightly different. So markets haven't priced any win there, one side or the other, and that's basically because they haven't decided. Generally there is a huge amount of uncertainty in the region over there. But again, I think the same point remains. It's the actual economic impact that either party could have is minimal. So in general, I'd say, not too much to worry about there for the impact it could have on markets.
Thank you, Mash. That's really interesting and hopefully very, very reassuring for our clients as well. So thank you for joining me today. I hope you've enjoyed our first video market update, and we will see you again next quarter.